for joining me today. Today's presentation is going to be on non-arm's length expenditure and I guess what I would consider the hardline approach that the ATO are taking with reference to these SMSF expense issues. Now, what I do want to address when talking about this stuff is that I think there are some issues that we can sort of take sort of a position on from where the ATO have been in this place historically as well. So whilst I think there is certainly some hardline issues to be mindful of, I think it's also important to understand that a lot of these issues have been around for a long time, and it's probably time for some SMSF trustees to get their house in order with reference to what they're actually doing as well. So anyway, as with always, if you've got any questions, please put them in the Q&A box for me. What I would say, obviously, from a disclaimer point of view, is that there's a lot of information to certainly be mindful of throughout this presentation with reference to legislative changes, and you may have already heard the other day that the government have made announcements with regards to this whole non-arm's length expenditure thing as a bit of feedback, or from feedback received from the industry, that they will review the position as well. So, it seems to be that we're in this never-ending sort of stream of potential updates with regards to non-arm's length expenses. And so, I certainly watch that with interest, because as it currently stands, there's some real critical issues that we need to be mindful of. So what I want to touch on today is, I guess, the considerations in light of the finalisation of the ruling. So we've got the LCR 2021-2. So I really want to address, I guess, primarily the differences that came about from the final ruling versus the previous version of the ruling, and what that actually means for us in the trustee space. And I'll focus primarily on this whole concept of individual versus trustee capacity. So the whole expenditure element, and where somebody is acting as trustee in their acting in their personal capacity as operating a business as such, or performance of some form of service, versus their trustee capacity. And some light was shed by the ATO in this space, but I do think in many respects it still sort of asks as many questions as it provides answers. And so I don't really think that we have this safeguard position from the release of this ruling, and I think that there's a little bit still to go down between now and the end of 2022, particularly with regards to general fund expenses, which is clearly the issue that's providing the most angst within the industry. But for myself, I've always sort of been conscious of those elements, but really have tried to drill down onto what I consider the regular day-to-day activities of SMSF trustees out there, and how they operate, particularly if they're doing property, or they have property management within their SMSF. So they've got either residential or commercial properties inside their self-managed super funds. To me, those sorts of transactions, and a few traditional transactions that we've always undertaken in the SMSF space, they're a little bit more, I guess, worrisome for me. Whereas as an industry, I think we are largely focusing on what impacts us as SMSF professionals as well. And if we're undertaking SMSF services such as preparation of our own accounts, what is the impact item? And whilst that's a big issue, I think we also need to look a little broader to that. So I will touch on the individual versus trustee capacity throughout the presentation, and the whole concept of in-specie asset transfers, because I think that has the potential to blow up on certain practices that exist within the industry still to this day. The image there, the non-arm's length expenses versus contributions and remuneration. So that's a guide that I've been writing and regularly maintaining in light of the original ruling coming out back in 2019, or the draft ruling coming out in 2019, I should say. And then with the updates based on the recent finalisation of the ruling. So everybody that attends today will get a copy of that guide. It's just over 20 odd pages So it's a little bit more in-depth version of what we're talking about today. So really talking at a sort of an overview level today through the issues, but by all means, when I send through the CPD to you, which will likely be, just with a few other things that I've got on, likely be early next week. But when I send that CPD through, then you'll have a copy of that guide at your disposal. And by all means, ask away any questions that you might have following on from having a perusal of that document. So as far as our learning outcomes are concerned, what I want us to be able to take away from today's webinar is the idea about fund members acting in their individual or trustee capacity. So have a bit of clarity around that, or as much clarity as I think you can get in the current environment. The impact of non-arm's length expenses on in-specie transfers and clarity around that, because again, as I said, there's a lot of practices that we've engaged in over the last 10 plus years, and I think they're impacted by these rulings a little more than perhaps we've contemplated. And so I want to address those towards the end of the presentation. How it impacts our ordinary and statutory income. So again, just using some of the examples from within the LCR to highlight the issues associated with whether or not the entirety of the income will be accessible over the entire term of the asset, or just a 1 year's worth of income, because clearly that's going to make a bit of a difference in certain sets of circumstances. And then what I'll finish off with is just a few sort of concepts very, very briefly around our remedies to ensure that we don't have non-arm's length expenses. And to me, this is, I guess, our common sense approach to being an SMSF trustee. And one of the areas that we ultimately have to deal in when dealing in this space and dealing as SMSF professionals, talking with trustees particularly, is, I guess, having those harder conversations that perhaps we haven't historically had with reference to the payment of expenses and other things, where we potentially let them fly by in prior years. Now we just need to make sure that we are, conscious of these requirements, these non-arm's length expenditure requirements, and what it actually means, and ensuring that trustees are well aware of what their obligations are. So I generally like to start, and I've amended this. I've done a few of these presentations since the 2019 document came out, and I've amended this timeline a little bit just to really highlight the key areas for myself, or that really guide my conversation piece when I'm discussing the issues with clients. And I go all the way back to TR 2006/7, which was our special income ruling from a tax ruling point of view, prior to super reforms and tax reforms of 2007, that saw special income become non-arm's length income. And one of the key messages, or one of the key examples within that ruling of 2006/7 was the concept of how we know that non-arm's length income still applies to certain private company dividends, and certain all discretionary trust distributions, and certain fixed trust distributions if there's some discretionary income in it, which was the crux of those three subject matters, were the crux of that ruling. But the ambiguity that I'll talk about in a moment was created by an example highlighted in that ruling, which was the Dorellan or the HAMFAM or HENFAM superannuation fund, where the fund received income that was in line with, or dividends in line with, all the dividends that other parties received as well, but they paid a lower amount for the shares than other parties had acquired them at. So they actually got some form of discounting on the shares when they actually acquired them. And so back in the pre-2018 timeframes, what the government and ultimately ATO are saying is that there's ambiguity around that we only looked at the income, not at the expense side of things. So the fact that we paid less for shares, whilst it was a trigger for determining whether non-arm's length income existed, it wasn't necessarily as clear as it should be, or supposedly that's why the legislation was changed, because that sort of concept wasn't as clear as it should be. And ultimately it meant that we had to look at the entirety of the transaction to determine if non-arm's length expenditure existed. Now, to me, the issue with that is that in a common sense environment and an SMSF regulatory environment where we're hit with issues like the acquisition of assets from related party rules, particularly, but also then the contribution rules that the ATO have released over a period of time, was that we always had this market valuation issue to be conscious of, and so we're now legislating and in many respects sort of putting this tight grip around our industry about these non-arm's length expenses based on the wrongdoings of the few and far between clients, and that's the sledgehammer approach that has occurred in many instances in the superannuation environment, certainly across my 25-year journey in this space. But it's an area that obviously we then have to say, okay, well, you've been doing the right thing all along and you've been practicing in certain ways, but we now need to make sure that everybody has the same message and that we're all saying the same thing and beating to the same drum. So that original ruling, I think, highlighted one of the issues that has been consistently driven through this LCR, which is the market value of acquisition of shares, or the acquisition of shares must be undertaken at market value. And to not do that, irrespective of the market value substitution rules, will create a non-arm's length income situation. So we need to be mindful of that. And then we had that tax ruling and the SMSF ruling back in 2010, which really drove issues around what contributions were and what assets we could acquire from a related party, and I'll touch on those as we go through. They're now key issues, which to me were the biggest drivers, and I've been fairly consistent in this messaging. Our key drivers of why we are where we are, and that is limited recourse borrowing arrangements. So, that interpretive ID of 2010 162 was to me the red flag of everything, because it ultimately drove the question from a SIS point of view about whether or not lower interest rates were non-arm's length transactions from a SIS point of view. And of course, from a SIS point of view, the answer to that, well, the short answer to that was no, because the transaction was no more favourable to the related party. Whereas from a tax point of view, which is what was addressed more so in tax determination 2016, was that the income of the fund, or the income of the fund, is measured about whether the transaction is more favourable to any party. And so our tax side of things takes a very different view. And so we ultimately get to a point where, to me, the key topics or the key issues that we need to address, not just now but on an ongoing basis, is the link between our ruling on non-arm's length expenditure and our historical rulings on what is a contribution and the rules around acquiring assets from related parties, because they're all implicitly linked. And as I'll comment on a little bit later, the tax ruling 2010-1 has ultimately been amended because of the LCR and because of, I guess, the ATO's position around in specie contributions. And again, it's how you read that document that will determine, whether people do the right or wrong thing, and it can be relatively misleading. Hence why I've tried to go in a lot more detail in the guide, more so than the presentation today, about the link between those. But where we sit with reference to that particular ruling and in specie transfers is going to be pretty critical for the way that we practice. I think largely for listed securities more than property transactions, but I will touch on that just based on some examples and experiences I've seen as I go through the presentation today. So from a glance, and again, I've highlighted this issue before, but we've got to come back, and I think this is why the government are potentially going to intervene in this situation. And when I say potentially, it would be really nice. They've said it at some recent conferences. We've had a couple of superannuation conferences in recent times for various bodies, and I know that the the government have commented about the feedback they've received as a response to the ATO's finalised ruling. And that is what is the ultimate purpose of non-arm's length income, and as has been the case right since it was introduced back as Section 273 or Section 273 of the Income Tax 36 Act, designed to prevent income from being unduly diverted into super entities as a means of sheltering the income from normal tax rates of tax applying to other entities. And this measure, or this sort of concept, has been reiterated throughout this process, right? Throughout this entirety of the introduction of the non-arm's length expenses. That statement, in its essence, has been repeated through each explanatory memorandum of the three attempts that they tried to get the legislation in place, by saying that with the reduction of contribution caps, and this is one of the triggers for it. So the reduction of contribution caps has resulted in more people trying to inflate their superannuation balances through other means. Now, again, I don't see that in everyday practice from an administrative point of view, and even from a presenting point of view. You have seen certain transactions that are undoubtedly non-arm's length income, and to me they're addressed by already the discretionary trust distributions and other means. But largely a lot of the measures that have been introduced through this LCR sort of go against the grain of what the original NALI provisions have been. And so I don't see that particularly general fund expenses go to any great level of extreme in overinflating how much money people have in superannuation, particularly if we're talking about fund expenses that represent sort of 0.5% of the super fund assets. So it's fairly negligible. But if we're coming down hard on that, then we have to be mindful of what it means in a whole heap of other circumstances as well. So, I always keep in back of the mind, and I hope the government do too, what the original intention of NALI was. But then if we go further and look at the introduction of NALI in a nutshell kind of way, then what we're looking at is obviously that there have to be parties to a scheme that are not dealing with each other on an arm's length term, and I'll come back to that in a moment. The income must be more than expected to derived if you are dealing at arm's length, and that is the issue, I think, with the general expense bit, is that all income is being received on an arm's length basis, but because there is a reduction in unrelated expenses, and the ATO can say that they're all related, but in essence, the fund administration fees have no bearing on the contributions received, no bearing on the income received from various assets, no bearing on the capital gains. So then how can we link that to the entirety of the income and effectively trip up the fund from a tax point of view? And that's the question as an industry that I don't think has been appropriately answered just by this LCR. So just because the commissioner has that view, it doesn't necessarily make it appropriate when we go back to what the key purpose of the introduction of this non-arm's length expenditure issue was, which in its essence was to reduce or to stop things such as limited recourse borrowing arrangements being set up with lower or no interest rate and sort of unpractical or impractical repayment terms as far as commerciality is concerned. And that's the crux of the introduction of the measure, but it's obviously become far broader since then. And of course, the increased piece is that there's a loss or an outgoing expenditure that is less than, including nil, expected if dealing at arm's length. It applies to acquiring an entitlement of fixed trust and earning income from that trust as well. So again, it's not just the assets inside the super fund, but assets inside the trust. And when we start to look at that comparative to, say, our 1322C regulated trusts, we already know that in that instance we have to be dealing, or that trust has to be dealing on an arm's length basis as well. So we're often talking about not just those 1322C because they're effectively already regulated a certain way, but if we're looking at other trust investments that the fund might be applying. So it does include our capital and ongoing expenses and applies to our ordinary and statutory income. So it's very broad from a measures point of view as to how it applies, and we need to make sure that we understand all the key elements to it. And so for me, it's why I like to address some of the issues from the explanatory memorandum. And ultimately, as I sort of one of my throwaway lines before was I said the 3 or 4 efforts that they got to get to the final piece of legislation. But we did have an EM going back to 2018 that was subsequently amended, then subsequently expired because of the election. And then we got our final one in 2019 that reintroduced it once the government were re-elected, and it expanded on the original terms. But there were some consistent messages throughout all of those explanatory memorandums. And I think these are the consistent messages that are genuinely necessary from a non-arm's length expenditure point of view, but where we've gone beyond those measures. And that is that we obviously need to be dealing, or we are dealing with a scheme. So for there to be a scheme, it requires dealing between two parties. And it can be a single party acting in more than one capacity. So where we've got our single member or our two-member fund where one person is acting in both their trustee capacity and their personal capacity or company capacity, and if we're acting in relationship between those two parties, then we have to make sure that everything's on an arm's length basis. But I think what's important also with reference to the whole concept of arm's length transactions is that we naturally as an industry sort of contemplate the idea that we're only talking about related party transactions. But the EM is quite explicit in its commentary, highlighting that it doesn't need to be, or the parties don't need to be related to be able to transact on a non-arm's length basis. So, if there's any sort of, you scratch my back, I'll scratch yours kind of arrangement in place with, property developments and the other means, maybe not necessarily the SMSF, but other parties associated with the SMSF, then potentially there's going to be non-arm's length ramifications. Now, my quandary in all of this is who's identifying that, and at what point in time will it be sort of put to the SMSF that there is a non-arm's length expense attributable to it? Because from an SMSF audit point of view, the SMSF auditor is going to do a certain amount, but if they're seeing fund expenses and they look reasonable for the investments held within the superannuation fund, and again they're seeing a wide variety of funds that they're auditing, what's their sort of I guess what's their sort of their band of acceptable expense rates? Are we getting to that point? And I hope that we're not getting to the point where we say, well, the appropriate expense rates must be between X and Y, and it takes more of an approach of saying, right, well, somebody saw appropriate quotes. This is what they've been quoted. This is what they've accepted. This is what they've paid, as to being more your standard process. Versus a situation where the ATO come in and say after the event, after all those other issues, that we feel that there's a non-arm's length expense transaction occurring. So, I think it's going to be a difficult area to administer. I think in many respects that's why the ATO are saying that if you put in some level of effort, and they're saying a little bit more than that, but they're saying that if the trustees, undertake their due diligence in determining what competitive pricing structure might look like, then ultimately the non-arm's length provisions aren't going to apply. So it's going to be one of those situations where those trustees, and we've probably all come across them, those trustees that just are adamant that how they're going to act is how they're going to act. And regardless of what we say to them, they still act that way. Well, then all we need to have is a caveat where we suggest to them, well, okay, well, you've got to understand that the end result is that the income of the fund will be taxed as non-arm's length income. Now, interestingly enough, when I've had those conversations with trustees over the past 2 years, the general comment is, okay, so the worst case scenario is that income is going to be taxed at 45%. And of course, at this point in time, arguably assuming that it's all about the investment and the lack of expenses. If the investment is a legitimate expense from a super fund point of view, and there's been nothing untoward in that transaction, but the expenses are lower, well, the answer to that question is yes. The worst case scenario is that income and potentially the gain on on the sale of that asset is going to be taxed at the top rate. Well, then I've had people that say, well, I'm already paying that top rate. So if the worst case scenario is that's what the outcome is for the super fund, then so be it, as long as the asset can remain in that super environment. So, it's an interesting situation, because some people have quite a blasé approach to that side of things, whereas others, invest 100% in super because they want that tax benefit, and to get that tax benefit, they need to make sure they're doing the right things. So the other thing that the explanatory memorandum did was it sought to remove the ambiguity, and I talked about that with the HenFam and the shares, where they paid less than their market value for those shares, but got the same dividend that all other shareholders received. So there was levels of ambiguity around that sort of transaction, as well as others throughout the history of special income and non-arm's length income. And by introducing an element of expenditure rather than just the income, it meant we were looking at both ends of the transaction to determine that all things were equal, and it wasn't just about the income being more than you expected, right? So if you sold it commercially and you bought it commercially, and therefore the income was more than you expected, that was always where we sort of looked at non-arm's length expenditure. But now it's about, at any point in time along the transaction trail or the investment trail, has there been something that's going to create a problem for that fund? So it was ultimately around removing the ambiguity. And when that was introduced back in 2018, most people kind of said, well, there's really nothing to see here with regards to the introduction of this non-arm's length expenditure, because most of us expect that the whole idea that you should pay the right thing for your investments already occurs. Most of us had seen the historical information released about the limited recourse borrowing arrangements, such as the TD 2016/16, PCG 2016-5. All of those issues had kind of led our industry down this right path anyway, but clearly there was enough additional transactions occurring that the regulator and government were seeing to prompt the change. So when we're talking about the real key issues of this all, which is the trustee versus individual capacity, we have to address a number of issues, and to me, this is where your standard SMSF trustees are going to run into problems if they're not provided with the appropriate guidance by ourselves as SMSF professionals when we're dealing in this space. So the key points from the law companion ruling is obviously, is there a sufficient nexus between the expense and the relevant ordinary or statutory income? So where is the link between the expenditure of that asset and then the income associated with that asset? That's our standard approach that we're looking at. We're also then looking at the fact that the expense may be deductible under general or specific provisions of the legislation. So it's not just our section 18 or 81, deductions that we're considering here from an expense point of view. There are other expenses that we need to take into consideration. One of the things that we do need to be mindful of is that the acquisition expenditure is inclusive of financing costs, will have a sufficient nexus to all ordinary and statutory income. So this is where we're differentiating between the draft ruling and the final ruling, and we got a little bit more certainty around the fact that some investments you'll have a link only to the income associated with the yearly income of the fund, whereas other things such as limited recourse borrowing arrangements, if there is expenditure that's lower than expected included in those financing costs, then there's going to be a sufficient nexus to all of the income, which means that not only will the rental income be non-arm's length income, but even the gain at the end of the asset term is going to be deemed as non-arm's length income as well. So, I think largely your property transactions, because they're generally bigger assets as such, are where we've got problems where there is the capital expense issue, whereas other transactions like overpaying rent and those sorts of things won't have an impact on the CGT side of things, just on the annual income. So if you've got your upfront costs right and your end costs are all commercial, then it's only going to be the rental in between. But if you're dealing in limited recourse borrowing arrangements, then if there's any sort of wavering on the interest or the terms up front that would suggest that it's not commercial, then you're going to have an issue across the entirety of all income associated with that limited recourse borrowing arrangement. And I guess that's why I highlight also tax determination 2016/16, because what that provides is, in the sense of the ATO, one of the more comprehensive examples of what appropriate looks like with reference to, in that instance, referencing back to PCG 2016-5 and making sure that the terms of the borrowing arrangement were correct, and saying that if you can't get the terms that you've applied in any sort of commercial circumstances outside of a loan, then generally you're not going to be able to receive the income that the fund is presumably going to receive from that asset, and therefore it will be tarnished with non-arm's length income. And that's the crux of TD 2016/6. So that's one of the key issues, particularly around property transactions, that we need to be mindful of. But then again, from us and an industry point of view, the biggest concern is that some of these expenses will have a sufficient nexus to all income. And without getting too sort of detailed from a presentation point of view, ultimately what they're talking about is our actuarial costs, our accounting fees, our audit fees, the cost of complying with regulatory provisions, which is in the SMSF sense linked to a number of issues associated with the Tax Administration Act. So most of those you're not generally going to see gnarly arising in that sense. Trustee fees and premiums under indemnity insurance policy, again, that's more applicable to APRA funds, because ultimately self-managed super funds don't have trustee fees, and we'll touch on trustee remuneration in a moment. But then we've got our benefit payment calculation costs, including interest on borrowed money and medical assessments. And this is an interesting one, because I had a scenario only recently where a client was looking to borrow money, and in this instance it was to borrow money to settle on securities. So you had your 7-day times, and we went through the for instance of how and when that can apply, and that was that at the time that you entered into the contract to buy the shares, you had the capacity to pay it, but by the time you came to settle, that you didn't, and so you could borrow for up to 7 days. Now, what we highlighted in that situation was that any borrowings really needs to be done on a commercial basis. Now, if you extrapolate that out for benefit payments, where you can borrow for up to 90 days and up to 10% of the value of the fund to pay a benefit that you're legislatively required to pay, then again, it's not just a matter of the SMSF receiving that money, say from yourself, to put it in to pay it out, and then have an asset redeemed that will then help pay that loan back. You know, ultimately what this nexus is here is saying that if you've got those benefit payment expenses, then you really need to look at, okay, what is an appropriate rate of interest, because zero isn't, despite the fact that if you go to the borrowing ruling, so not limited recourse borrowing, but the standard borrowing ruling, and I'm going to go out on a limb and say 2009/3, but I'm probably wrong with that number, but it's in my my guide. When you look at that, it talks about interest as not always being an element of what constitutes a borrowing arrangement. But just because the ATO have addressed that in a historical document doesn't mean we can say, okay, well, because interest doesn't apply in that example, it shouldn't apply in borrowing to pay a benefit payment. And these are all the areas that I think self-managed super funds need to be mindful of, even if we only come across these things once in our entire sort of admin or advice life. We need to make sure that people do the right thing, because we don't want to be the one responsible for trustees having to pay 45% tax when they otherwise didn't think they needed to. So something to be mindful of in that regard. Investment advisor fees, including pre-retirement services, and then to me probably the most problematic fee associated with the whole transaction, other administrative costs incurred in managing the fund, which to me is a very, very broad statement with reference to anything else that we are paying in the example of running our fund that it could be captured under these non-arm's length expenditure measures. So that to me is the catch-all area that we need to be mindful of. And by extending those general expenses, what we're actually looking at then is that we're basically talking about, okay, well, this has an impact on fund administrators. This has an impact on relationships with our accountants. It has a relationship with our stockbroker or our insurance broker, because where do brokerage fees sit in amongst all of these things? Are they investment fees? Are they general expenses? But if there's a capacity to discount brokerage, we already know through the history of time that there's always been that capacity to discount commissions on insurance offerings. And so are those discounted premiums or discounted commissions on insurance proceeds, are they in line with commercial practices, and are they being provided to all parties, not just related parties and other things as well? So all of these questions that we have just sort of assumed were okay historically now become relatively critical in the ongoing administration side of the fund, from those advising on the investment vehicles and things, right the way through to the trustees just managing their own fund. And that kind of links into those next 2 points, which is property managers and building and construction. Now, again, whether you're appointing externals to manage your property and you're appointing externals to do any improvement, then largely you will expect that those transactions are going to be commercial and not come across as any arm's length issues. But if you have any skill set in performing those services yourself, or indeed you are licensed to perform those services, then you open up the can of worms of Section 17B, the remuneration issue. You open up the can of worms of what is a contribution from an improvement point of view. You open up the issue associated with acquiring assets from a related party. We'll touch on SMSF ruling 2010 one as well. So to me, as much as this ruling has got our backup about accounting and admin fees and discounting, there's going to be, given the proportion of self-managed super funds that invest in property and the number of questions that we get on a weekly basis about trustees performing some form of task on their investment property, that to me is going to be the critical points that we need to be mindful of. And of course, I put a question mark for other relationships here. One that's often thrown back at me at that point in time is audit relationships. Well, you would expect that in the general sense that audit relationships are obviously independent to start with. So first, you've got your independence there, but there might be some form of pro bono type arrangement where that concept that I mentioned before of you scratch my back, I'll scratch your scenario, and do they offer any sort of fee discount for other services that you might provide? Like it might be me coming out and providing education or something else. And so full disclosure, I don't receive any discount on my audit fees, but they're the sorts of relationship issues that we need to be mindful of. And so then we have to identify, okay, well, under what responsibility are we undertaking our actions? Are we acting as a trustee, or are we acting in our individual capacity, or do we not know how we're actually acting in regards to the way that the fund is operating? And so if we look at the trustee capacity side of things, again from the ruling, we've got a responsibility as trustees to perform certain duties, and we are required to do that under various statutes. So it might be under the SIS Act that we're required to do it. We might have it under our Trustees Act, so our fiduciary responsibilities as trustees, or it might be a condition under the trustee to the fund that we operate and do things a certain way. Now, if we're providing tasks or we're undertaking certain activities based on those things, then you can assume that the capacity it's being undertaken is as a trustee. And the fact that you have obtained certain skills along the way doesn't mean or doesn't say that you're doing it under your individual capacity. And again, I would consider myself a perfect example of that situation, is that I perform the administration of my fund. I don't do the lodgement of the fund. I appoint a tax agent to do that, and obviously I don't do the audit. I have someone else to do that, but I can perform the administration of the fund, and I pay an arm's length rate for the software to do that. But I don't charge and can't charge myself to perform the administration role. So, that's one of those areas that, because of the skills that I've got or received over my time in industry, I can actually perform and undertake those transactions. Versus the individual capacity thing, and what the ATO address in their ruling there is, if you've got the capacity to charge for the services provided, if you're using the equipment or assets of the business in a material manner, that to me is almost, I won't say it's the scariest line of the ruling, because there's plenty of other scary elements to the ruling, but that concept of material manner it's akin to the de minimis rule with contributions. It's akin to certain issues associated with, I guess they restricted the pension one to being 1/12 of the minimum, but wherever there's been some form of discretion, and again, they talked about it with insufficient or insignificant value. We're talking about contributions and service provisions and those sorts of things. When we're talking about materiality, then what's material to one person versus another person? Is it percentage based, percentage of time, percentage of value? And this is where we don't have a definitive position. And the examples that are provided by the regulator, and I'll go through a couple in a moment, but those examples, all they tend to do is show you the extremes. And when you're dealing with the extremes, it's easy to say that to trustees. Well, if you're at one end or the other, you've got either no problem or a problem. But it's the variations of grey in between those extremes that we have to try and work out. And so we have to try and put systems in place with our clients to ensure that we don't have to look into that grey area. And we'll touch on that a little bit later on. So if you're performing services pursuant to a license or qualifications relating to business, I can only perform those duties because of that license, then clearly you're acting in your capacity as individual trustee. And I'll touch on the examples within the LCR of, say, a plumber versus an electrician, and the electrician who must provide that electrical certification certificate or whatever each time they perform some form of service. Then ultimately you're always going to have a situation where you're having to charge. And if you're an electrician, you can't just do the work for your fund for free. That's the way I would interpret that. And then how many other industries is that going to apply for? And again, things like activities being covered by insurance. So if we look at probably the key issue for many of us is that concept of discounting and reduced fees. So one of the things that they want us to address in this space is that if we go through the individual versus trustee capacity concept, then we need to be able to distinguish which capacity that we're undertaking things. But if it's going to be in a situation where we are dealing with another party, or we're performing the work ourselves in the capacity of individuals, well, then any sort of discounting that's associated for any sort of pricing has to be based on a sound basis for arriving at that. And so, I'll give a couple of examples a little bit later, but how many quotes do you need to obtain elsewhere, or what do you need to provide with reference to what you provide to your other clients to justify that what you're doing is commercial? That's the sort of things that trustees will need to determine there. And if we are offering discounts, so this was the point of relief for a lot of those of us in the SMSF space, is that there's nothing wrong with having discounts provided as long as they're consistent with normal commercial practices and provided to all employees. Now, there's a caveat within that as well, which says if you influence the business's decision to offer those discounts, are you still entitled to that discount, or does that potentially create a non-arm's length expense issue? And that's kind of, it talks about all partners and directors and all sorts of things, but if partners and directors are influencing the decision, then clearly there is a potential for it to be non-arm's length expense, and I think that is still not as clear as it needs to be for us to move beyond 2022. And the PCG, the compliance guidelines, have given us till 30 June 2022 to sort this issue out. So there is a little bit of time for us to ask questions of the regulator if we're in those situations of potentially offering staff discounts as to whether or not it's acceptable to all parties or not. And then, how much influence, as I said before, do you have on those pricing policies? So let's look and work through a number of examples as to how all of these issues, I guess, differentiate from each other and where they become problems from a fund point of view. And if we look at the examples straight from the LCR from an accounting point of view, it's where we're seeing that it's obviously a fine line between Mikasa and Leone with regards to how they're operating. But Mikasa works for an accounting firm, and she gets that accounting firm to provide the accounting services for the fund at no cost. Now, clearly the no cost bit is not an appropriate discounting policy. So that's one of the things that we can take away straight from this. It's like going back in time in limited recourse borrowing arrangements. 0% is not an appropriate rate of interest. $0 charging is not an appropriate discounting policy for providing services for the accounting work for self-managed super funds. I think that's one of the takeaways, so that when we're working it out, we can rely and say, okay, well, that's not going to cut it. So in this instance, because the accounting firm performs that service for Mikasa, all of the income of the fund is going to be non-arm's length income, versus the Leone situation, where Leone provides the services, and she is a qualified accountant as well, but she uses her own equipment and then doesn't charge the fund for it. Now that's okay. Now what's also okay, and there's further examples provided about financial advisors who buy and sell some shares in the evening using their work computer that they've taken home with them, which again opens up all sorts of other issues about, does it have to be out of hours, is it inside hours? All these sorts of things are somewhat questionable to me. But if you are just using your work equipment sort of in an insignificant way, as Leone is, then it's not going to be a problem from a NALI point of view. But by extension of what I mentioned before about LRBAs and the fact that all the income will be tarnished for the entirety of the asset, even if you go back and refinance and try and fix the situation, which means it becomes untenable in the sense of limited recourse borrowing arrangements of how somebody would operate there. But in this situation, if the accounting firm offers Mikasa a discount, and that discount is $0, then all of the fund income for that year is going to be non-arm's length income. However, if that matter is then rectified and the next year either an appropriate discounting policy is applied to all employees, or there's no discount policy applied and Mikasa pays full tote odds for the administration of the fund, then in that instance, the income that year would not be considered non-arm's length income. So, as I said, it's one of those areas of trying to work through the key issues and determine what's appropriate and what isn't. And so it's why I put that original timeline up there, to say there are a whole heap of other issues that we do need to take into consideration. So we need to consider Section 17B and our trustee remuneration, or the exception to the trustee remuneration rule. We do need to contemplate tax ruling 2010-1 about superannuation contributions. And we also need to consider SMSF ruling 2010-1, the application of Section 66 and acquiring assets from a related party. Now, TR 2010-1 and SMSF ruling 2010-1 have reference to both the provision of services side of things, because they both highlight those issues, but they subsequently also have issues linked to them with regards to acquiring assets from a related party that I'll come back to. So if we address the key issues under this trustee remuneration piece, then we can just sort of allude to the key acquisition issues that we need to be mindful beyond the ongoing service provisions. So from a trustee remuneration piece, we know that that we can be provided with remuneration. So SMSF trustees can be remunerated if the service relates to duties or services other than their capacity as trustee. So again, if we go back to that earlier slide, I talk about your obligations under the Act, your obligations under the deed, your fiduciary obligations as trustee. So all of those services can be provided for free. Any services that is provided beyond that is going to be provided in the capacity as potentially an individual. So then you've got to determine whether or not it's insignificant or it's sufficient enough to warrant trustee remuneration. If it's sufficient enough to warrant trustee remuneration, then you've got to make sure that it's on a commercial basis so that you don't trip up under the non-arm's length expenditure requirement. And I think that's one of the key issues out of this, is that you can perform certain duties that aren't trustee duties. You can perform them individually, but it's that de minimis concept of what is okay and what's not okay. And I think the examples help a little bit, but as I said, there's an element of grey in between that we need to be mindful of. So again, to be remunerated, you've got to be appropriately qualified and licensed to perform the duties and services, which is why I see property transactions as being one of the more critical ones, because how many trustees renovate their properties, be they investment properties or commercial properties, and spend weekends fixing up around the house. Now, how many external people do they bring in to do that, and how much work do they try to do for themselves? Because if that's enhancing the value of the asset, are they improving the asset? Are they therefore making a contribution to the fund? Are they potentially then triggering non-arm's length expenses? And that, to me, is a problem that hasn't necessarily been addressed beyond a couple of examples. As I said, perform their duties in their ordinary course of business. So doing weekend work that you don't normally perform, you can't be remunerated for it. So then, is it insignificant in what you're actually performing to be able to undertake those roles? No more favourable to the trustee than if dealing with arm's length. So there are critical issues that we need to be mindful of. And then how does that all tie in with SMSF ruling 2010-1 and tax ruling 2010-1, and then ultimately LCR 2021/2? And that's the quandary that we develop. But if we look at the TR 2010-1 examples of what is a contribution and what isn't a contribution, and if you look at Jasmine, she's got a self-managed super fund, she's a CA, prepares the accounts and income returns for the fund without any remuneration. So in that instance, sort of, what questions do we have to ask Jasmine? Do we ask her what equipment she's using, right? When is she performing those sorts of duties? They're all the sorts of things that LCR 2021/2 bring up that weren't brought up in 2010-1. And that's one of the issues to be mindful of. And then you go and look at other alternatives and other issues, such as when an in-specie contributions of shares is made, and the timing of it. And I'm going to come back and touch on this issue in a moment. But the whole situation here, where Chung size an off-market transfer to effect a contribution of shares from herself to her super fund. However, she leaves part of the form blank to be completed by the broker. The broker adds the omitted information at a later date. Therefore, the off-market transfer effectively occurs at that later date. Now, to me, this is a transaction that occurs all of the time, right? But it often happens in reverse, and that is that the broker fills in the information and sends it to the trustee to sign. Now, they filled in the information and they put a value or the consideration as of a date, and then the trustee signs it at a later date. That, to me, is a red flag issue, because the contract, which is the off-market transfer, and this is coming to the point that I'll tidy up in a moment, the contract is saying that the market value is X, but then the date that the contract is executed is a later date. And if the shares have increased in value, then we've ultimately got an off-market transfer worth more than what we've put the consideration for in. And the way that the LCR is written, it's that difference is going to ensure that those shares will be subject to non-arm's length expenditure. So they've effectively been introduced at a lower value than they should have been. Now that to me is problematic, but it's also systematic in that that's how our system and how our industry has operated a long time, and we have to look at potentially changing those issues to ensure that we don't create problems for our funds. So you can see that just a standard scenario that we have will create problems for our superannuation funds. Similarly, with the SMSF ruling 2010 one, you've got the performance of services insignificant in value, where you replace the tap washers. That's not an acquisition of an asset, but if you go and then install an air conditioner, then how did you fund that air conditioner and the appropriate work there? If you've done it yourself, if you've bought it yourself, then it's an acquisition from a related party, and that can cause issues. And how do those issues then tie in with the LCR? Well, for me, they tie in quite nicely when you look through some of the examples, example 9 and example 10. As I said, I expand on a lot of this sort of stuff within the guide as well. But this is the grey area. And so if we actually identify example 9, which is a plumbing example, and it talks about Trang, who is a qualified plumber, and after work, Trang goes to one of her SMSF investment properties and installs a hot water service that's been provided by the tenant that will be removed when the tenant leaves the property. Well, they're saying that the fact that she uses some of her own or some of her business tools to install that hot water service, then that's insignificant or insufficient to warrant it being a non-arm's length expense because of the fact that she doesn't pay. However, then she has another investment property and she uses her own skills plus her apprentice to do the development of that property and doesn't pay an arm's length rate for it. That would be a non-arm's length expense. So, where's the difference between, or not where's the difference, what happens in the scope between installing a hot water system that's been provided for you, so maybe a half-hour job or something, I don't know, I've never installed a hot water service myself, and a complete renovation, and these are the sorts of things that we need to be conscious of, is from a transactional point of view, what's appropriate and what's not. And then example 10 is the one I alluded to before about electricians and the fact that you need to provide the certificate of compliance for undertaking that electrical work. And so therefore you must always be remunerated in that set of circumstances. You can't just go off and do the work yourself. So there's such a quandary that's being raised in the broader sense of trustee and individual services, well beyond the accounting side of things. I think the accounting side of thing has been well and truly clarified by the ATO's ruling and then the introduction of discounting policies, but there is going to be a greater issue on the area that's actually live as we speak. So the accounting stuff and the general expenses is effectively quarantined as such until 2022, whereas property expenses and property transactions and those other sorts of relationship or transactions that are linked to a specific asset, they've been live since 1 July 2018, and to me are relatively problematic. So we need to understand how that all works. And so when you summarize all that, if you're appropriately qualified and don't charge, then it's going to potentially be a contribution as such and non-arm's length expense. Is that the case? Overcharging is going to be a financial assistance to a member or a related party. That's going to be potentially a problem. And then overcharging is going to be a breach of Section 109 because it's more favourable to the related party. So, all of these SIS and tax issues arise from the transaction. So, look, I wanted to just finish off with the acquiring assets from a related party issue, and I alluded to it a little bit with the transaction of the shares, and I'll highlight a couple of examples from the ruling. But the way that this operates, and really I think it's one that I want people to be able to go away and digest from a transactional point of view. If a fund purchases an asset at less than market value in a non-arm's length transaction, then it's non-arm's length. Then it's going to be a non-arm's length expense. on the acquisition, and then that will result in gnarly from the rental point of view and a CGT point of view. That's all well and good to say, but in practice, aren't all self-managed super funds dealing on a market value transaction anyway? So are we taking a sledgehammer to a walnut approach here with this concept of market substitution rules and other things, or were those elements of the ruling not directed at self-managed super funds? Now, clearly, it is directed at self-managed funds to the point that some of the examples reference people with their own funds, but who is allowing their trustees or their clients to undertake activities like this on a non-arm's length basis in the first instances? Aren't we already drumming into clients the requirement to act on a market valuation basis? And aren't we trying to encourage our clients to ensure that they obtain independent valuations prior to entering into these transactions, so that they don't come across these issues? So shouldn't we be taking that education approach first with our clients and saying that if you don't do things this way, right, if you don't undertake a proper valuation and then transfer that asset at that proper value, then you risk the entire fund or the entire asset being taxed at 45% when you sell it. Now, that's going to be enough for a lot of people to do the right thing, I would have thought. But where the ruling, the LCR, becomes problematic is that concept like the share example that I gave just before from SMSF ruling 2010/1, TR 2010/1. And that's where there's a difference between the terms of the contract and how much they actually account for in the super fund. And this is where it's, I guess, an issue, is because what we need to actually understand is what is a contract. Now, for most of these transactions, for self-managed super funds dealing with related parties, it's just the off-market transfer form or the land title transfer form. And so it's ultimately about what consideration is placed on that document. It surely can't be about the funding of that, because the funding of that is the settlement process. And the settlement process is saying, I'm going to fund this market value transaction by acquiring or by purchasing with X this amount, and then with contributing Y being the balance of the amount. So as long as we're documenting the transaction in accordance with a market value transfer as linked to the off-market transfer form, then our transactions should be okay. It's where we look at the scenario like I raised before of the off-market transfer form, where we just sort of have the form filled in, have the consideration filled in, and then we date it 2-3 weeks later and lodge it, and the market valuation has gone up significantly. That, to me, is where these non-arm's length expenditure provisions have the capacity to kick in. But people like myself have been banging on about off-market transfers since 2007 and the introduction of the contribution caps anyway, and people should be ensuring that they are executing all elements of the form, the consideration and the date, to reflect the same thing. So, whether it's the way we practice these things is something that needs to be addressed to ensure that we're not creating a non-arm's length situation for our client. So again, the ruling does provide a couple of examples there as to how it works, and we need to be mindful of the one where, again, if you look at that first example there, where the property is valued at $800,000 and then they acquire it for $200,000, no one's doing that, and if they're doing that, then they deserve to have that treated as non-arm's length expense. And I think that's something that we need to be mindful of there. So, as I'm saying, does anybody actually undertake that versus the part purchase, part in specie? Now, I think where this example goes wrong is the documentation side of it and making that too difficult to document. But as I said, given that most people don't enter into a full contract for sale when they're doing it from themselves, but rather do the land title transfer, it's ensuring that the land title transfer is reflective of the appropriate market valuation. The market valuation is supported by an independent valuation. Then the supporting documentation identifies how much will be paid for by the fund and how much will be contributed by the member. As long as we step through all those points, then to me, there's not a non-arm's length expense issue for the fund. So from an administrative point of view, to summarize that and wrap it all up, it's a matter of executing our off-market transfers and land title documents correctly. As an SMSF service provider, we need to make sure that we're identifying income items that might need further investigation. So not just from an expense point of view, but our trust distributions, our unlisted trusts, is everything behind the scenes, because I go back to that point about it not having to be related parties to be a non-arm's length dealing. Are we identifying all those key issues when dealing with our clients? What expenses don't we know about? That's always been the one, I just paid for that myself. There's no invoice on file or whatever, those sorts of things, trying to move away from those sorts of practices. And to me, the one from a building point of view and property management point of view is about seeking appropriate quotes for services before undertaking any actions with the fund. So as I come to the summative part of it, if anyone's got any questions, if you want to put them into the Q&A, because I know I've been through a lot in this hour, and so it's a fair bit to take on board. But if you've got any questions before I close up, then please put them in the Q&A box, and then I can answer them as we finish off. So that is seeking appropriate quotes, and I'm going through the process at the moment. I'm selling my house, and so I've gone out and sought appropriate quotes for window cleaning and carpet cleaning and painting and all those sorts of things. Now, some of those roles I can do myself, and others I'm going to pay others to do it. But in the SMSF sense, if I own an investment property and I got a quote from a painter and then I went and did that for free, then have I ultimately created an expense that is sufficient or significant or insignificant? So it is one to be mindful of in that situation. So if we're summarising the bit about our discounting, then the LCR is going to have relevance from 2022. So we really need to address that now. But of course, the main summative position is that we always should be recommending that all our transactions are undertaken and maintained on a commercial sense. So look, that does bring me to the end of the presentation. I'm not sure, Anne, if you have a question there, if you because you've raised your hand, if you wanted to put it into the Q&A box or into the chat box, so I can potentially help you out. But otherwise, thank you all for attending. As I said before, as part of today's presentation, you all will get a copy of that guide, which is today. It's really hard to talk about all this sort of stuff in the time frame, so I apologise for going a couple of minutes over. But the guide is a little bit more comprehensive from an example and thought process point of view. So please have a read through that, and if you've got any questions, always feel free to get back to me. Thank you for attending. And I look forward to you attending our next webinar at the end of November. So no questions coming through. Thanks very much, everybody. See you later.